Good morning, everybody, and welcome to the Daily Energy Markets Podcast. It is September 11th, 10:30 a.m. UAE time. Everybody's dragging themselves away from the reviews on the great debate last night between Donald Trump and the Vice President Harris, and we have to see how it seems initial results, as they love to do. Who's the winner? Who's the loser? And it seems that Kamala, at least, is getting some noise as being the winner. As much value that offers for 5 minutes, it seems. But what's happening in the oil markets is much more interesting, because this is the first day of the year where the market opens under $70 a barrel. Trading opening this morning at 69.84, if you like, down and trying to climb up above 70. No better person to have on the airwaves in this day in which there's a 6 next to the Brent crude oil than Mike McGlone, Senior Macro Strategist at Bloomberg Intelligence. Mike, I hope you had a good summer. It's great to have you back. And welcome your initial thoughts as to what your assessment. A lot of people shocked at this price. A lot of people, you see a lot of noise coming out of Singapore, the big gathering of APEC there. Some big names like Jeffrey Curry, Carlyle saying, oh my God, this is oversold, etc. You've been calling this for a while. Your thoughts?
Yes, to me, this is part of the deflationary dominoes. That's very typical in commodities. After they go up too much, they go down. Crude oil is just part of one of those dominoes. I mean, natural gas led it. U.S. natural gas dropped earlier in the year to lowest prices since first traded in 1990. The grains, the most elastic commodities, corn, soybean, wheat, have dropped to levels that were first traded in 1973. And that's on the back of the high price cure. They went up too much, incentivized massive supply, reduced demand, and now are heading back lower. The key thing is, how much lower does crude oil go? I think it goes down below the U.S. cost of production, which probably means it has to print into a 40 handle. Now that's WTI. Brent shouldn't fall too much. That's not very profound to say that. It's been doing that for years. And I think what we have in crude oil and commodities is basically a perfect storm for a bear market. And what you're seeing in crude oil is just excess of supply globally, demand decreasing. Look at bond yields in China, 2.11% on a CGB 10-year this morning. That's probably a new low. So signs of pretty severe, I would say, recession going towards depression in China, massive supply in the U.S., excess capacity, surplus capacity out of OPEC increasing. And there's one key thing that's holding everything up in all commodities from this trickle-down deflation. That's the U.S. stock market, which is starting to give way a little bit as we head towards a contentious election in the U.S.
Let's welcome Matthew Wright, Senior Freight Analyst from Kepler, back to the table. Matthew, I hope you had a good summer. Everybody's looking at China, and there's obviously many reasons why the sort of oil price and the oil markets are coming out of the summer looking a little bit vulnerable and falling. And the big one that is getting most attention is China and the Chinese economy. Obviously, China is the world's biggest oil importer. It's been the source of the biggest oil demand growth, incremental demand growth for the last 20 years. What are we seeing in the freight rates that tells us about the health of China? We hear a lot of anecdote about China. What is the actual sort of volume, the typically lots of freight moving out of China to everywhere in the world?
Yeah, good morning. Good to see you again. Yeah, absolutely. You just need to look at what's happening in terms of Mideast China or West China to see that there's not a lot being shipped compared to where we were. And that's definitely having an impact on rates. I mean, if you look at China now over the sort of short to medium term, there's sort of a balance of positives and negatives. You know, starting with the positives, always good to start with the positives. We've got the Yulong refinery, which is starting test runs of a new CDU. You've got Sinopec have a new refinery adding capacity. CNOOC have a refinery adding capacity next year. You know, the other good thing is these new refineries tend to avoid purchasing sanctioned crude. So this is going to benefit benefit OPEC. If they're not bringing more supply, it's going to be sort of tightening that availability. Saudi Aramco lowered OSPs again. So we're at, I think, the lowest diff to Oman, Dubai in maybe 2 or 3 years. Some positives, but on the negatives, we're seeing lower product export quotas. We're seeing a slowdown in manufacturing, and fundamentally, we've still got some excess crude import quotas among private refineries. So coming towards the end of this year, that rates are starting to tick up in September. That is seasonal. That's to be expected. That shouldn't be confused with a more bullish story around China. It's still looking pretty weak, and I'm not expecting any fireworks over the next 3 or 4 months.
Just to follow up on that, Matt, one of the biggest sort of trade routes in the world is the freight rates from China to West Coast America. Is that showing the ailment that the Chinese economy, that the trade flows between China and the US are declining? Because that was a bionic number for a long time, China to the West Coast.
Yeah, on the container side, yeah, absolutely. And I think the thing to keep in mind there is the disruption in the Red Sea created such dislocations in the market, particularly for containers. Containers were affected far more than any other sort of shipping sector, just because of the risk tolerance among those owners was far lower for understandable reasons. They're carrying cargo on behalf of millions of other people. The rates there have sort of moderated, but we've seen so many spikes that I think that's almost separate to what's going in terms of demand. You're going to continue to see that. The Red Sea situation remains pretty much as it was before. It is almost, it is almost as worse than it was when it began. So that we're seeing lower and lower volumes passing through the Red Sea. You take Russia. Russian crude has accounted for the vast bulk of cargo that continues to pass through, and we've seen some Russian cargoes, elect to go the long way following attacks on ships carrying Russian cargoes. So yeah, the situation for containers, for LNG, for tankers is pretty much the same there.
Let's go to Yuri Humber, founder and president of Japan NRG platform Yuri Group, based in Tokyo. Yuri, wanted to get your insights. Just obviously Japan, a critical country, a big economy in Asia, and big LNG importer. What are we learning from LNG? Because that seems to be one of the outliers in terms of doing well. LNG prices have held up. Where is demand and the outlook for LNG, and what does it tell us about the health of the economies in Asia?
Thanks very much, Sean. And yeah, I guess, look, I'll just before I touch on LNG, I'll say that Japan is in a slightly different part of the sort of the macro cycle right now. And in a positive way, because as you probably know, Japan's had the negative interest rates for so long, or it's had, pretty much zero interest rates for what seems like forever. And so we actually had the first raising of rates by the Bank of Japan earlier this year. The rate differential between Japan and the US has been basically the biggest thing weighing down on the yen and making the yen weakness so pronounced. So we've had the yen touch at close to 165 to the US dollar, but actually today momentarily it went down to 140. So there's been with the rising of the rates, with the US now the Fed seemingly moving towards cutting of the rates, there's actually a strengthening of the yen. And that is going to have quite a strong impact on the volumes that Japan is able to and is willing to purchase in terms of fuels. So, even if for most people, the price of crude has looked like it's either stagnating or going lower, Japan's actually been buying less but spending more. Even just looking at some of the latest data from this summer, you see volumes down 8%, but you see spending in yen terms like up in double digits. So of course, in that environment, Japan's been quite cautious in terms of not just crude imports, but LNG imports too, which have been somewhat sporadic and a little bit lower than the recent 5-year average. But I think as now we head into the restocking for the winter season, which is one of the two peak demand seasons in Japan, I think there might be a little bit stronger appetite for securing cargoes than there would have been otherwise with that stronger yen. And certainly in the last couple of weeks, the latest data shows that there's been quite a considerable jump in the stockpiles and in the import figures. Now, that's still keeping things at more or less the 5-year average level. But again, if this sort of yen strength and momentum continues, then I think we could see a further uptick there.
Mike, we have obviously big decision coming regarding the Fed rate cuts, and they've acknowledged that it's now time to cut rates. And so then the question becomes, well, how much and how fast? We have some CPI numbers due out from the US today, which may signal either whether it's a 25 basis point or 50 basis points when they meet next week. Your thoughts on the outlook for that? How important is it or not for the direction of travel for the oil markets?
It's important. The significance, I think, of these rate cuts, it's the most widely anticipated rate cut cycle I've ever seen in my almost 40 years in the business. So the market's already priced for it. Buy the rumor, sell the fact is a problem for risk assets. And the Fed's probably going to cut 25 basis points in September 18th next week. The market's priced for a little bit more than that. But it's the beginning of a reason they're cutting rates is because unemployment's going up. The inverted yield curve is just starting to disinvert. One good example, as my colleague Joe Levington pointed out yesterday, 34 straight months of increasing auto loan delinquencies in this country. A lot of signs of pretty severe slowdown. I look at it from my standpoint. I see declining demand for diesel, unleaded gas, and container boards, all showing from a commodity standpoint, we see pretty severe deflation kicking in. So the Fed's catching up. And the thing is that's mattered about this is the bond market's way over it. The inverted curve is still quite significant. I look over at that 10-year note yield at 3.61 and Fed funds still at 5.25. That's a pretty good sign of deflation coming. The thing is, you look at the 10-year note yield in the rest of the world, they're much lower. So the Fed's catching up, I think, and I think we're beginning now is a period of rates going down on the elevator after they went up on the down on the escalator, going down slowly after they went swiftly on the elevator. And I think it's going to be a cat and mouse game between rates going down and an economy tilting over to a recession and the stock market going down. So all this is quite, I think, the beginning of a bear market for the stock market, and it's just catching up in that bear market for commodities. And the question is, what makes the Fed start easing much more rapidly? And we all know what make it do that, and that is if risk assets go down more, spreads widen quicker. But we're heading towards a recession, unemployment's increasing, and the Fed is just getting started. The thing is, though, I end with this: their inflation metrics are still above 2%, their goals. So it's just the body's in motion.
Matthew, I wanted to talk a little bit about where things go for OPEC. We had OPEC publish yesterday their latest monthly report, and had a very incremental to insignificant downward revision in global oil demand growth for 2024. They knocked off 80,000 barrels, but they still have it at a whopping 2 million barrels a day demand growth, which is probably close to double the global average of most other independent analysts that is seeing it closer to 1 than 2 in terms of growth. But I wanted to get your thoughts of, OPEC announced last week when this oil price was sort of dropping fast that they would postpone their raise of supply, which was to start in October. They pushed it out 2 months. Your thoughts on where OPEC goes from here? Do they have any weapons left? They've already 6 million barrels of shut-in production. Is there any more they can do as this sort of rock continues to fall through the water?
Yeah, so, clearly, I think it was very well signposted. Everybody was in agreement that postponement was the right decision, and that is proved pretty clearly to be the case. I think the situation is they kicked the can down the road. I don't think the situation in terms of balance is going to be that different come early next year. We are expecting a bit of a excess in supply moving into next year. So even as we've got, essentially OPEC are now waiting out that decline, expected decline in non-OPEC supply. So from Brazil, US, Guyana, although we do have in Q3 next year more Guyanese production coming online. So if they bring it back too soon, when that OPEC production is still high, we're gonna have this situation, but more accelerated. We're gonna see prices pushed even lower. So the only real option, you're not going to see further cuts. I just don't think that's in there. That's completely contrary to their agenda at the moment. But do we see further postponement in cuts? I'll leave that to my crude oil analysts in the team who know a little bit more about it. But they've done the right thing for now.
Do we see any of that appetite? I mean, from the point of view, where are tanker rates at the moment telling us about the demand or the hunt for empty tankers, that people want to move more oil or less oil?
It's been a very quiet summer. Summer is always a very weak period for tanker rates, but this was weaker than usual, and I mean weaker in a relative term, coming from where we were in the spring. One thing that I think is particularly interesting is we saw a record number of VLCCs and Suezmaxes, the largest crude carriers, switching over to the clean market. So in August, we saw record volumes of clean products being shipped on tankers. Over 30 Suezmaxes, about 10 VLCCs made the switch. So absolutely record numbers. You don't do that if the crude market is in good health. So this tells you something, that the market, is definitely going through a lull. Now, as I said, we're moving into Q4. Q4 and Q1 are typically stronger markets. So I'm not expecting this switch to clean to sort of continue, but it's definitely having a bigger impact on the market. And then the knock-on impact on the clean sector, the tankers that traditionally carried clean products, has been significant. Because of these dirty tankers moving in, they are making up 10% of clean tanker demand. So absolutely huge share, record high share as well. So, this is definitely unexpected. When we were, peak of the Red Sea crisis in February, March, I think most people were expecting that dislocation would keep that freight market elevated for as long as the situation persists. The situation is still persisting and rates have really come off. Don't get me wrong, we're nowhere near where we were in 2021, but it's certainly not looking to be a very strong winter period for freight.
Yuri, I wanted to get your thoughts on the China question, which of course is so pivotal to the direction of travel for most commodities, and obviously oil, as China the world's biggest oil importer. But from Japan's perspective, does it concur with this global sort of bearish analysis of China weakness? There's reports from Bloomberg that Japanese companies, which used to be the biggest investors in China, are now pulling out quickly. Where's the domino effect from the Chinese weakness on the Japanese economy, and what's the perspective from Japan?
Well, absolutely, China is the #1 trading partner. So for Japan, even though we have a much tougher geopolitical environment, we have incoming and increasing number of goods that are being either sanctioned or tariffs added to them because of US sort of pressure on Japan to join, especially in the semiconductor related space and other high tech. So that definitely weakens Japan's ability to export in some of these sectors. I think there's been still a fair amount of stockpiling, especially in some of those advanced chips and so forth, by the Chinese parties, so that the volumes have still been quite strong, and there have been other workarounds that various industrial sectors have found. But how that continues with a weaker Chinese market, I'm not sure. I think that we will see a knock-on effect on Japan and a certain slowdown in the economy. That said, I think at least for this quarter, Japanese economy seems to be on an uptrend, and recent economic GDP numbers have been quite good, quite strong. So I think that in terms of the energy import side, we'll still see at least short-term quite strong numbers, but maybe in the first quarter, the slowdown will become more pronounced. As for just, Japanese investments in China, as you mentioned, that obviously geopolitics is one issue, but there are others. The Chinese government detained one of the very high-end executives, high executives of a Japanese pharmaceutical company, seemingly on charges of espionage. That set off a lot of alarm bells amongst top executives in Japan, because there was no sign to sort of indicate that this was indeed something espionage related. So there's just a general unease, I think, about among quite a lot of Japanese companies about making further investments in China, partly because of the geopolitics and partly on that sort of more human level.
Let's go to the survey question, which is tackling that point we asked earlier. With 6 million barrels per day of cuts already adopted by OPEC plus 22 countries, does OPEC plus have any more cards to play to reverse price decline? Are they out of weapons here in terms of track? I mean, this is we've hit a $92, $93 on Brent in early April, and it's been pretty consistently downward since then, obviously with corrections, but ultimately the trend has continued. It just didn't start just last week, this decline. It's been underway a while, and through this year, we keep hitting new year-to-date lows. And OPEC plus have been quite good in the past at reacting and stopping this bloodletting in the oil markets. But do they have anything left? That's the question. Yes or no? Mike, I wanted to get your thoughts on where the fundamentals are. I mean, we do have, and most notably yesterday, and then for the last few days, as I mentioned in the introduction, Jeffrey Curry from the Carlyle Group sort of advocating, and others, that this is an oversold. The fundamentals are still good. We have overnight crude oil inventories, the API numbers, as they're called, out in the US, again, reporting further declines in US crude oil inventories, which the API have reported is down 7.4 million barrels. Your thoughts on the relevance of that? It used to be a gold standard impact inventory reports every week. They've lost their velocity to impact the market. But from fundamentals point of view, how do you interpret those lower than average inventories?
Not very little correlation, either positive or negative, to prices anymore. It's like I wrote twice in the last few years, Facts and Fantasies of crude oil pricing. Like, people still look at rig counts in this country. Rig counts are the same as they were 10 years ago, yet production's increased 100%. It's the things that it's the thing I enjoy about crude oil is the questions are the same, the answers have changed. And that is, we're in a pretty significant global macro deflationary, almost perfect storm. And just look at the EVs coming out of China. I drive an EV. Mine's 10 years old. We're having a pretty significant pressure on new technology replacing petroleum on a global basis. And virtually every major country in the world that produces automobiles has to put tariffs on all these renewable sources coming out of China, or they're going to crush their own industry. So that's a major source of demand getting crushed, the incremental demand getting crushed. I pointed out we have declining demand for diesel in this country. It's the same price it was 2014. It's never happened outside of a recession. Even unleaded gasoline demand peaked in 2019. You mentioned 6 million barrels a day of reserves coming out of basically
shut-in production
capacity coming out of OPEC. Well, just one thing about that is, before COVID, the surplus of supply out of demand versus liquid fuels and crude oil in the U.S. was around 2 million barrels a day. Now it's 6. It's just the question of what you need for this to stop is lower prices. And that's been the case since 2018. So it's been a pretty significant trajectory of lower prices in Brent. And we peaked at 147. We popped out to 140 in 2022. There's very little things to stop it from going back down to 40. You got to get to that lower price cure, typically. And the thing is, it's not isolated. It's virtually all commodities, with the exception of gold, which I think is going to continue to rally. And then you tilt over to the big picture macro, and that's, I think, the biggest risk, I think, for all crude oil traders is you just have a little bit of a normal back and fill in the U.S. stock market for a bull market. And we haven't had that since last December. So to me, that's the tilt. I don't know what shifts that.
Matt, looking at, you mentioned earlier, obviously, as we've been tracking all year, the situation in the Red Sea and the disruption of all cargo, all traffic, shipping traffic through the Red Sea due to the Houthi attacking ships. And we have most spectacularly currently an oil tanker on fire in the Red Sea that is unmanned, and the attempts to salvage it have not been successful yet. But I wanted to look at the wider implications of that. And we saw at the end of last year and into this year, the impact on the Panama Canal, also disrupted not by geopolitics, but by water levels, and having dramatically decreased the volume of traffic through there. My question to you is, these choke points, these bottlenecks in the shipping lanes around the world that have been quite dramatic in their impact, but not in the pricing, not in the flow, and where is that at generally from the point of view? Have these two big events now been absorbed and are just a part of business as usual?
Yeah, it's a good question. And I think to an extent, you're right. They have. I think just generally speaking, the world is much more now accustomed to, almost weekly black swan events. There is a high level of risk priced into the market a lot of the time. The situation also it's also important to remember, for a lot of time, freight is a very small component of the cost. So you can absorb quite a lot of volatility in freight and it not affect the flat price too much. There's other bigger things often happening in the market that are affecting that. But for freight that's passing through the Panama Canal, situation there is obviously a lot better. We've got water levels on the Gatun Lake, which have increased. And the situation in the Red Sea is one of more like adaptability. People are adapting to the situation in the best way they can, whether that means that people are sending less crude east-west, west-east, or products, or they are just soaking up that extra freight cost. That's just the way it's going to be, I think, from now on.
You're just wrapping up with the outlook for the Japanese economy. There does seem to be some inconsistency there about where rates are used in order to support or restrain an economy. We have Japan's economy expanding in the second quarter at a pace slightly lower than the initial estimate, but still at an annualized 2.9%. Where does rates and economic growth in Japan intersect? We're seeing in the US, they're now intersecting. I mean, the economy is doing great and they're cutting rates, so I don't quite understand that. But nonetheless, where in Japan do those two intersect? Because obviously, a lot of things have gone out of whack for so long in Japan, of stagflation, rates below zero.
Yeah, well, I think like Matthew said, I mean, there's a lot of absorption going on with Japan in terms of sort of freight charges. That's maybe not the biggest issue from Japan's point of view. It's the geography, being, with so much of the, especially LNG, coming from Australia, more or less that sort of supply is covered. But if there are disruptions, as we saw in 2022, and even in 2021 with the Panama Canal issues, then suddenly, at least in terms of Japan, the knock-on effect can be quite strong because, Japan doesn't have, unlike Europe, it doesn't have underground natural gas storage. So you've got 2 or 3 weeks of LNG essentially storage capacity here, and therefore, any kind of disruptions, they don't necessarily maybe impact the global price, but they very quickly make themselves visible in the electricity price in Japan, which spiked to unheard of levels, triple-digit levels in the yen per kilowatt hour. So that is kind of the biggest crisis scenario, and that's sort of worst case scenario for Japan. the fact that, you know, ships don't make it, or there is a further geopolitical crisis, whether that be from Russia or from elsewhere, or some bottlenecks that stop the ships. But I think in the longer term, one of the other things to look out for in terms of Japan is that, you know, this month we have a runoff, the new LDP leadership election. So whoever wins that at the end of this month will take over as the prime minister. They may very well call a snap election. And then it will be a case of seeing what the new prime minister is interested in terms of the energy picture, because Japan is currently in this process of revising the strategic energy plan. The previous strategic energy plan significantly lowered the outlook for LNG and coal sort of in 2030. With the current AI boom, etc., requiring a lot more energy, there may be a slightly more, let's say, sympathetic or more pragmatic approach taken to midterm imports and so forth.
Right.
So I think that's another thing to look out for.
Well, we'll have to leave it there. This room thinks that OPEC are out of cards to play at this particular moment. We'll post that on social and see if the rest agree. Thank you so much for your return to the table today. Mike McGlone, as always, in from the US, Matthew Wright from the UK, and of course, Yuri Humber from Japan. Great to have a round the world in 30 minutes to give us a sense of where these markets are going. I think everybody's kind of scratching their heads. Have we hit a bottom here? Will a bottom be reached without any intervention? With so much supply, idle supply ahead of demand, it seems with further economic weakness, that this is a market that's a little bit attached to going down rather than up. We'll wrap it up there. Thank you, guys. All the best. Talk to you soon.
Cheers. Take care.